This is the Simplify Volatility Premium ETF, ticker symbol SVOL. In this video, we'll discuss what is SVOL, how is SVOL managed, how SVOL's distributions work, and finally, portfolio implementation. SVOL seeks to provide investment results before fees and expenses that correspond approximately to 1/5 to 3/10 the inverse of the performance of a short-term volatility futures index while seeking to mitigate extreme volatility. With the prospectus language out of the way, let's take a closer look at what's inside. SVOL has about 20 to 30% short exposure to VIX futures. It seeks to provide a high income stream while also seeking to protect against extreme volatility. Before we dive deep into the strategy, what is the VIX? The VIX is the CBOE Volatility Index. It represents the market's expectation of equity volatility over the next 30 days. Investors consider it a measure of stock market fear or stress. It typically, but not always, moves inversely with stock prices. Therefore, a strategy like SVOL that shorts the VIX will be positively correlated with stocks. This chart represents the average VIX futures term structure since 2007. On the left is the average level of the VIX index. Moving to the right are the average prices for the different futures contracts. Future 1 represents the contract that expires in the next month. Future 2 represents the contract that expires in 2 months, and so on. You'll notice that as the futures contracts move further away from the expiration date, the average price is higher. In other words, the line is sloping upwards. Futures traders call this being in contango. Historically, VIX futures are in contango 85% of the time. SVOL attempts to profit from this contango by moving down the curve from right to left. It will sell short VIX futures contracts, ride them down the curve through time, before eventually buying them back, ideally at a lower price. This is called harvesting VIX roll yield. This process is repeated continually, with the fund distributing profits to shareholders in the form of monthly distributions. Here is the fund's investment process. Step 1 is to harvest VIX roll yield by selling VIX futures. This is the core strategy. In step 2, the majority of the assets are invested in income-producing securities. This is possible because trading VIX futures requires little cash outlay. Step 3 is to employ strategies to manage tail risk. Let's examine each step in greater detail. Step 1 is to execute the core VIX selling strategy. SVOL will short VIX futures contracts with about 20 to 30% exposure. The fund will hold the contracts while they ride down in value through time. Eventually, the contracts will be repurchased to close out the positions as they approach maturity, and will then be rolled into new contracts. It's important to note that the futures contracts are not rolled all at once. It is a gradual and continual process. Step 2 is to invest the majority of the fund's assets in income-producing securities. This can be in the form of treasury securities, such as treasury bills, notes, or treasury inflation-protected securities, also known as TIPS. It can also include buying fixed income ETFs. Finally, the fund may do some limited fixed income option selling to enhance income even further and as a tool, similar to using limit orders, to acquire fixed income securities at attractive prices. Step 3 is to employ strategies to manage tail risk. The first way to control risk is via term structure positioning. When the VIX is high, the fund will gravitate towards selling near-term futures, such as the second-month contracts. This will maximize income while maintaining a higher beta. When the VIX is low and there is a greater risk for a mean reversion higher, the fund may sell longer-term futures, such as 4 to 6 month contracts. These contracts have a lower beta to the VIX. A small number of hedges such as VIX call options or equity put options are used as an always-on hedge to add some protection for an unpredictable tail risk event. Lastly, fixed income securities such as treasuries can often serve as an effective hedge during times of crisis. What are the drivers that will determine SVOL's return? We can divide the drivers into tailwinds and headwinds. On the tailwind side, a steep VIX futures curve will enhance returns. The steeper the curve, the greater the differential between the sell price and the buy price. The other tailwind would be a falling VIX futures curve. Remember that SVOL shorts the VIX, so a decline in prices across the curve will enhance returns. On the headwind side, a flat or inverted VIX futures curve detracts from returns. When the VIX term structure is inverted, which has historically occurred about 15% of the time, SVOL may be buying back the VIX futures at a higher price than the one at which they were sold. Another headwind would be a rapidly rising VIX curve, which may also cause the VIX trade to be unprofitable. Let's take a quick look at the differing return drivers between stocks and SVOL. Stocks have two primary drivers of returns: earnings and the multiple that the market places on those earnings. SVOL's return drivers are the steepness of the VIX futures curve and the level of the curve. Even though SVOL and stocks will be positively correlated, the differing set of return drivers makes SVOL an effective portfolio diversifier. When it comes to diversification within equities, most investors think of metrics such as large caps versus small caps, domestic stocks versus international, or value versus growth. While these traditional metrics are important, investors can benefit from an additional layer of diversification that can be gained by having some assets that capture the structural nature of the volatility premium. Let's take a moment to understand SVOL's distributions. We'll discuss SVOL's distribution policy, accounting treatment, and what it means for investors. SVOL's distributions are managed. The distributions are based on an estimate of the fund's long-term carry. Carry equals the income received from the fixed income part of the portfolio, plus whatever VIX roll yield is earned through the core VIX selling strategy. The goal is to keep distributions relatively stable, making infrequent changes to the distribution amount. This makes it simpler for investors to plan their cash flow. In some months, the fund will distribute more than it actually earned. In other months, it will distribute less than what it actually earned. Over long periods of time, the goal is for the distributions to closely match the actual carry. Now let's discuss the fund's accounting treatment. When ETFs make distributions, the distribution amount is typically placed among categories such as income, short-term capital gains, long-term capital gains, and return of capital. Because of the specialized accounting rules associated with VIX futures, the fund will rarely have significant capital gains distributions. The majority of the distributions will typically be classified as income. Return of capital may occasionally be a percentage of the monthly distributions, independent of whether the fund realizes a profit or a loss for the period. In other words, return of capital is primarily an accounting metric, not an economic one. It is simply a reflection of the accounting treatment that's required for VIX futures. Investors may wonder, if distributions are sometimes classified as return of capital due to accounting rules, how does the investor know if the fund is actually making money? That's an easy question to answer. Simply look at the fund's total return. Investors should check to make sure they are looking at the total return, which includes distributions, and not just the price return. Total returns cannot be managed or manipulated. Total returns are the ultimate truth of how an investment is performing. It is the most important measure that investors should be concerned with, far more important than distributions themselves. In terms of investor goals, the most obvious use case for SVOL is for investors seeking income. But it's not just for income investors. It can be used by any investor who is simply looking for another source of portfolio diversification. As for implementation, investors should consider SVOL as part of an equity allocation. If assets are being sold to make room for SVOL, they should come out of an investor's equities if the goal is to maintain a similar risk profile. Now for some Q&A. If a flat or inverted VIX futures curve is a performance headwind, should investors sell their SVOL shares if the VIX futures curve inverts? The VIX futures curve often inverts during times of market stress, when the VIX becomes temporarily elevated. If the VIX mean reverts back down, investors who sold would have missed out on potential gains. It would be similar to selling stocks after a market crash. An inverted VIX curve can often be a great entry point for a short VIX strategy. If a rising VIX is a performance headwind, should investors sell SVOL if the VIX is very low? A low VIX often coincides with a steep futures curve, so the strategy can still generate attractive returns even with a low VIX. Furthermore, the VIX can remain low for a long time, months, even years. Selling SVOL because VIX is low is a form of market timing that is unlikely to be successful for most investors. The VIX seems very volatile. How risky is SVOL? Yes, the VIX is volatile, but remember, SVOL only allocates 20 to 30% of the assets in the VIX futures strategy. The fund also has risk mitigation strategies it can employ. Since its May 2021 inception, SVOL has had both lower volatility and lower maximum drawdowns than large-cap U.S. equities. How similar is SVOL to covered call equity funds? Both types of funds attempt to create income from equity volatility. Both are positively correlated with stocks. The most important difference is that covered call equity funds are fully exposed to stock market drawdowns, but their upside returns are capped, as selling call options means the fund is selling away much of its potential gains. That's why over long periods of time, covered call equity funds underperform traditional equity funds. SVOL, on the other hand, has no such cap on potential gains. What would cause a change to SVOL's distribution rate? That's going to depend on a number of factors. For example, the VIX term structure flattens for an extended period of time. That could result in a lowering of the distribution, or if interest rates dramatically decline, that will impact how much income the fund can earn from its fixed income portfolio. It's important to note that the distributions will not be changing from month to month in reaction to short-term market fluctuations. SVOL owns some ETFs. Are shareholders paying the expense ratios of the underlying ETFs in addition to SVOL's expense ratio? No. SVOL's published expense ratio includes all the underlying expenses, including the expense of any ETF it might own. Thanks for watching this presentation. To find out more about this or any other Simplify ETF, please go to simplify.us. You can also book a meeting with us directly. From our homepage, just click the Contact Us button on the main menu. We look forward to speaking with you.